What's up, YouTube? Eric here. You guys voted for it. You got it. 10 dividend stock ideas in 10 minutes. Let's get after it. Now, of course, I always encourage to have diversity in portfolios, and you build that foundation, that blueprint. Dividend stocks are part of that. Today, we're going to cover 10 stocks, a combination of DGI and DGIF, so dividend growth investing. Dividend growth investing for FIRE's total growth. If you follow the channel, you know what I'm talking about. But there's going to be different types of dividend stocks, higher dividend and lower dividend. First one is Intel. And here's the thing, guys. It's a $163 billion market cap, but it's paying you a 3.65% yield. PE ratio 6.65. Is this my favorite semiconductor stock? Absolutely not. You know that it's not. But this is focused on dividends, and I want some high yield and some stuff that's could be a value. This could be considered a value stock. They're trying to build a foundry in the US and Arizona. It's down 30% on the 52 week, and this could be an opportunity. So check out Intel paying a 3.65% dividend yield. So this next one I covered on YouTube a while back, and it was in the $30 or $40 range. Bought this thing way back here sometime at like 40, 50 bucks. Made 100% gains on it. I sold the stock when it was close to $100. The 52-week range on it now is $64.58 to $96.82. This is NetApp, $15 billion market cap. It's a 16.5 P ratio. I think it's starting to get attractive again here in the 60s. 2.95% dividend yield, which is solid. If you're not familiar with the company, they provide software systems and cloud services to manage and share data on-prem as well as hybrid and private clouds and networks. So these guys are more of a legacy business that's trying to get more into the cloud, and they're not going to be a hyper growth stock or anything, but it's attractive. 16 P ratio, decent balance sheet, 2.95% dividend yield, NetApp. Now, these stocks aren't in any particular order, but the next one is SBUX, paying about a 2.5% dividend yield. It is a 21 P ratio. You gotta be careful with some of these stocks. Some will do better in a recessionary period than others. Think of SBUX. People are gonna maybe spend less money on coffee, less consumer spending. The consumer confidence level is very, very low. The sentiment reading, I think today was 50. It was 85, not long ago. So this is one of the lowest consumer sentiments we've had in a long time. So consumer discretionary stocks like this will get hit. It's a $90 billion market cap. This is one that I would watch if it goes lower. I think it's a buy if it gets back in the 60s. It was $68.39 on May 12th. It could get back to those ranges. I think that's where I would look at potentially buying it, maybe under a 20 P ratio on SBUX. One of my favorite stocks still, I've owned this since 2012. I bought it in the 30s. This is Microsoft. It pays you a little bit less than 1% dividend, so you're not buying this for a huge dividend or anything, of course, but it's going to give you some decent growth. It is one of the more expensive stocks on my list today at a 27 P ratio, but I think it's getting really attractive around $250, especially if it gets below $250. It did get to $246 on May 20th. If it gets back below $250, it could be something to look at. All these stocks could go lower, so you'd be dollar cost averaging, and all these stocks are for long-term investing. So you're going to get paid that dividend to wait, you're going to DCA, and you're going to buy levels if the stocks go lower. So this one's not quite as expensive as Microsoft in the PE, but getting pretty close. It's a 26.79. Microsoft is in the 27 range. This is UnitedHealth. This is going to be a $459 billion, very large cap, 1.35% dividend yield. I consider it a DGIF play. The reason I like this is it is somewhat recessionary proof. Not that the stock can't go lower, but people are still going to need healthcare insurance, whether the market's good, bad, or indifferent. So this is one that's often considered defensive in nature and could still do well even in a downturn. I like this one for diversity. If you need healthcare stocks, I personally don't have a ton of healthcare stocks, and I do own this one. I've had it for a while. UnitedHealth, ticker UNH. Now this one we were buying in Discord, like $140, $150 in that range. This is Tractor Supply Company. It's about a 23 P ratio, 1.8% dividend yield. It's a $22 billion market cap. Now this one's also in consumer discretionary, so you have to be careful. My thought on this though is when you think of Tractor Supply Company, I think it's gonna hold up better than most retailers. I think it'll do all right. Under $200, dollar cost average, I think it's attractive. This did get down to $166 on May 25th, so keep that in mind. I think if it gets back in that level again, it's very attractive. This is one I consider DGIF. I think this is a great long-term play. Management does a great job. They're continuing to build more in what I call tier 3. So when you think of tier 3, these suburbs they're a little bit further away than like the Home Depots, more in rural areas, but the tier 2 suburbs of the cities can still drive out to them, and the rural people can still get to them as well. Plus some of their stores are in areas where there's really no competition. So they have monopoly in some of these smaller towns, and they're much more than just Tractor Supply parts. They sell everything from clothes to pet supplies, veterinarian services. They do a lot. I think it's a great company. I think this stock is going to go higher over time. Now this next one is going to be utility. We don't talk about utilities much at all. But when you think of having some diversity in the portfolio, 4.2% dividend yield, 17P ratio. This is NorthWestern Corp. This is an energy utility. It's a $3.24 billion market cap. I know this company really well because it's headquartered in the city I live. Also have to disclose that a family member works for this company, and they have, haven't told me any insider information or anything, but told me a lot about how the company operates. And this is one that I think a lot of people just don't know about it. Now, this was down to $53 back in November. That was the low on it, and the high was 65. This isn't going to give you a huge return on the stock price. This is more of an income stock, meaning you're really holding it for that 4.2% dividend yield, but it should do well. Even if energy prices are high, people still need to pay for electricity to heat their home in the winter and to cool it in the summer. And this should continue to do well. It's just not on a lot of radars because it's a smaller company. It's in the Midwest. Check it out, ticker NWE. Now, I don't know this company very well, but James from our community, our Discord community, he also writes on Seeking Alpha. He actually owns this company. He's pretty bullish on it. 13P ratio, 3.4% dividend. When I do stock screeners, this always comes up as one of the top stocks when I'm looking for growth metrics with dividend yield. It's a $2.2 billion market cap, consumer staples. Now, so what it does is manufactures, distributes weight loss, weight management, healthy living products. Again, I don't know a lot about this one, but I know a few people that are very bullish on it. It's one to at least explore. Seems like a pretty attractive level at 13P ratio with a 3.4% dividend yield. The low on it was $154 back May 25th, so it has bounced nicely off that, but still seems attractive at these levels and lower. Now, when I think of financials, this is a $13 billion market cap. It's only a 5P ratio. Now, banks in general don't carry, very high P ratios, right? But 5 is still even pretty low for a financial institution. This pays about a 3% dividend yield. It's down 26% in the 52-week. This is Ally Financial Inc. So, of course, these guys, digital financial services company. It's kind of a digital bank, basically, right? Consumer, commercial, and corporate customers, United States and Canada. They've got 4 segments: automotive finance operations, insurance operations, mortgage finance operations, and corporate finance operations. I owned this stock a long time ago. I think it's attractive at a 5P ratio and a 3% dividend yield. I don't know the company very well. You'd want to do some more research, but I wanted to include it on the list because it does seem attractive here. Now, I get asked about this stock a lot. Taiwan Semiconductor, TSM, dividend yield 2%, it's 2.12%. P ratio is a 22. Now, under $100, this thing was $85 on May 12th. I think it's attractive, especially if it gets to like $75, something like that. Below a 20P ratio, I think this is an opportunity for TSM. The reason the stock is held back, I think a lot of it has to do, it's a depository receipt, and it also has a lot of risks, I guess, around China. People are worried that China is going to invade Taiwan and that this is going to be impacted. And that's really the sentiment of the U.S. investor and maybe international to an extent. But I know as a U.S. citizen, I can tell you the sentiment for a lot of these Asian ADRs is not very good. But I do think this is a must-own kind of semiconductor if I'm creating a semiconductor ETF. They are the global leader in foundries. Huge companies like NVIDIA, AMD, Apple, they all rely on Taiwan Semiconductor, and it's a very important business. So check this one out, especially as it goes lower. TSM, 2.12% dividend yield. I promised you 10 dividend stocks in 10 minutes, and I got it done. Now, we need to thank Motley Fool because they did sponsor this video. And if you want to check out the 10 best stocks to buy now, check out fool.com/firedupwealth. Also, subscribe to the channel. You can watch the videos free. I've been doing more and more of these videos. And subscribe, click that bell to get notifications. So every time a new video comes out, boom, you're going to get a notification. Drop me a like and comment if this is helpful. Have a great rest of your day. Take care.